Welcome, everyone. My guest today is Daren Blomquist, Vice President of Market Economics at Auction.com, to talk about what distressed home sales can tell us about the larger 2025 housing market. Before we dive in, I want to thank our sponsor, Optimal Blue, for making this episode possible. Daren, welcome to the podcast.
Thank you for having me, Sarah. Good to be here.
It is great to have you on here. You know, I've been following Auction.com and what you guys do since I joined in 2013, since I joined HousingWire. And, you know, gosh, back then it was a whole different market, right? And
Yeah.
I just feel like we are coming into 2025 in a really interesting space. And I'm excited to talk to you kind of about what you're seeing from your data that could be some leading indicators for everybody else in the market.
Yeah, absolutely. Yeah, in 2013 was really when we started, Auction.com started doing foreclosure auctions specifically. So that was a milestone for Auction.com. We were doing the bank-owned auctions before that. But anyway, that's just a side note. So that's kind of actually 2012, but that's an important time frame for us when all of a sudden, and things were different. We're still dealing with the overhang of the foreclosure crisis at that point. But what we're seeing in our data is, for your listeners who may not know, what Auction.com does is two types of auctions. We do the foreclosure auctions, which are the properties that sell, typically known as selling on the courthouse steps. And then we also do the bank-owned auctions, or REO auctions, properties that have been foreclosed and are owned by the banks. And then those are being auctioned off as well in some cases, although sometimes those are sold on the regular retail market as well. So what we're seeing in our data, and what I've seen since I joined the company about 5 years ago, is that there's this really rich data set of near real-time bidding data and buying data that we have on our platform. And the folks who are bidding on our platform are typically very knowledgeable about their local market. They're what I call local community developer. They're the person who's buying usually a fairly high volume of homes every year and renovating them. So they're very aware of the market. And so our bidding data tends to be very instructive on what's coming on the market, because those folks usually, their success depends on them accurately predicting what's going to be happening in the market in the next 6 months when they're renovating the property and then reselling it and putting it back on the market as a rental or a resale. So anyway, all that as a precursor to say, what we're seeing in that bidding data is really, just to simplify it, the demand. There's basically two demand metrics we look at, and those demand metrics have both been falling basically for the last 6 months on our platform. And one of those is a sales rate, which is basically the percentage of properties that sell at auction that are available for auction. And then the second one is the pricing, the price to value ratio that our buyers are willing to bid. And then also, we look at what our sellers are willing to sell for as well. And that our sellers typically our buyers are ahead of our sellers. Our buyers are saying, okay, this is what we're willing to pay relative to full market after repair value. And that metric has been coming down basically for 6 months. And then also what our sellers have followed, and for the last 4 months, we've seen that the pricing on the part of our sellers come down as well. So that all points, those demand metrics, especially when we've seen those come down for an extended period of time like that, that does indicate softness coming in the retail market.
I think this is really interesting because, yes, so we're not talking about the volumes of distressed properties, obviously, thankfully, that we were talking about in 2012 or 2013. But it doesn't really matter the volume. What you're talking about is looking at what are the signals, despite whatever the volume is, correct?
Exactly. Yeah. And the volume, to be fair, is relatively low. It's running at about half of 2019 levels, a little bit less than half of 2019 levels. So, you still have foreclosure volume happening. Foreclosures are still happening. But yeah, I think thankfully, most people are thankful that we didn't see maybe the big surge in foreclosure activity that some might have expected given the pandemic crisis. I think we can safely say that's behind us. But yeah, this is not about the volume. This is just about the the demand metrics, the what we call the conversion metrics, how these properties are selling on our platform, and who's bidding on them, how much, how high they're willing to bid, and how many of the properties they're willing to buy.
So I think one of the big questions for 2025 that people are wondering is like, what are home prices going to do, right? And we're just in this really interesting market where, higher mortgage rates didn't bring down home prices the way that some people thought. Now we're looking at a little bit more inventory, like we're up, I think 27% year over year. That's great. Mm-hmm. That's still pretty low. I don't even know that we're at 2019 levels. So when you look at this demand, what does that tell you about what you think the larger market home prices are going to do?
Yeah, I think what I'm seeing so far is pointing to slowing home price appreciation, not necessarily negative. It's a little bit hard to discern, is that going to go negative? But to maybe set the stage for diving into those numbers a little bit more detailed, if we look back, the last time we saw kind of a similar trend in our demand data on our platform was back in late 2022, early 2023. And at that point, of course, one of the things that was triggering the demand drop on our platform was the rise in mortgage rates. And we saw the demand metric of that, the sales rate drop by 7 points between, let me see here, February and June April 2022 and December 2022. And then the price that our buyers were willing to bid, their highest bid relative to what we call after repair value, that dropped by a whopping 15 points between April 2022 and December 2022 as well. That's when mortgage rates were skyrocketing. And then what we saw, that was more extreme than what we're seeing today. What we're seeing today is about a 7-point drop in over 6 months in that price that our buyers are willing to pay for properties. But after that 15-point drop that we saw back in 2022, of course, you can look at different numbers, but if we look at the National Association of Realtor numbers, we did see in 2023, a few months after we saw that signal in our data, we saw 5 consecutive months where median home prices, according to the NAR, dropped on a year-over-year basis in 2023. So we did actually have, at least according to those numbers, a slight correction in home prices in 2023. It was a tough year. So what we're seeing now is not as extreme as that, all that to say. So what it's pointing to, I think, is more of low single digits home price appreciation, at least in the first half of 2025. So yeah, that's what we're looking for. I mean, I would caveat that in saying that I think the election, not to necessarily that we have to get into politics, but the election might have played a part of this too. But I think the other thing that our buyers were looking at when we surveyed them, what they were looking at was rising inventory numbers, which you just referenced. And I know I look at the Altos numbers very religiously for those weekly inventory numbers, because our buyers look at those and they're saying, if inventory is rising in my market, that means more competition for me when I renovate these distressed properties and resell them. And so they look very carefully at those. I think that's influencing this drop in demand. And then the election, though, I think when we survey our buyers, seems to be something that pops up as well. And so I am curious to see, as we start to see our December numbers now, which I can talk about a little bit as a preview coming out, what's happening in December, if just the certainty that came about because of the election is giving our buyers some certainty to have a little bit more confidence.
I think it's one of the things I've noted about the election, whether you wanted one person to win or not, having a certain result that we're not still litigating, that we don't think is going to, lead to some big thing that happens in January. I think that stability is just so important. And we see it in other metrics as well. So that wouldn't surprise me. So when you think about because I definitely want to get into what you're seeing in December, talk a little bit about the people who, like your buyers, because like you said, they have to make sure they're getting the right price at the time of buying and selling, right? Because these aren't people who are buying, generally speaking, to live in the to fix it up and live in the distressed property, correct?
Correct. Although, I mean, on a side note, we do see a surprisingly and actually growing number of owner occupant buyers, but that's probably a topic for another podcast. But it's still, about maybe 13 to 15 to 20% of our buyers actually call themselves owner occupants, but the majority, to your point, are real estate investors. What I call real estate investors. A lot of them also happen to be real estate agents. They know their market very well. Most of them are buying. They're not the big institutional Wall Street funds that maybe it was true at one point back in 2013 when you started at HousingWire. And congratulations, by the way, for being for what your basically 10-year anniversary.
Thank you.
So back then there might have been some Wall Street funds buying at foreclosure auction. That's not happening anymore. Mostly it's these, I call them local community developers. They buy within basically a 100-mile radius of where they live for the most part. And they a lot of times are both real estate agents and investors who are buying these properties. And these properties are typically pretty highly distressed, unless you get lucky once in a while with one that's not as distressed. But they need to be good at renovating properties and kind of be able to handle losses here and there as well when you come across a property that's in more extremely poor condition. So yeah, that's a basic profile of our customers. But they they're usually buying maybe like 10 to 50 properties a year, something like that. So they have a high velocity of data that they within their own universe of their sales that they're dealing with. They also have a lot of anecdotal data. They know when they're listing a property for sale, it's taking now 2 weeks for me to sell that property, or I should say it's taking 2 months to sell that property as opposed to 2 weeks. And so they see that kind of thing, and they're very, very close to the pulse of the market.
I think that is fascinating. So tell us what you're seeing for December so far.
Yeah, so what we're seeing for December is in those demand metrics, there is actually a pretty good pop in the sales rate, which is that first demand metric I talked about. Looks like about right now 3 to 4 points in 1 month, which is pretty big. And so it's still, I don't want to overread into that. It's still early and we still have the end of the month to get through. But that could be an indication that our buyers have said, okay, the election's over, there's some certainty. We can a little bit more confidently buy properties. And so and then the price that they're willing to pay, that hasn't gone up as much, but it edged up just a little bit, or it's so far this month, it's edging up a little bit, maybe a point. So they're willing to pay a little bit more relative to after repair value. So yeah, there are some early signs that there might be a shift in their confidence in the market, but still typically given the last 6 months of data that, that what we've seen in December so far isn't enough to turn that around.
So that was going to be my next question is at what point, when do you feel confident you're seeing a trend? How many months, how many, or what sort of things do you go, okay, I feel confident in this trend?
Yeah, I usually got to have at least, in my mind, at least 3 months of data going in the same direction to be really a trend. And it can, I should mention it varies. I'm talking about national trends at this point, but it does vary. And sometimes I do dig down in the geographical areas. And what we see is the demand metrics tend to be weaker in the Southeast and even basically through the Sun Belt. So you see from kind of the Western United States through, Arizona, Texas, over Louisiana, over to Florida, even Florida would be included, would have some of those weaker demand metrics. And I think there's a lot going on there that may explain that on the retail side of things. And where you actually see stronger demand metrics and even improving demand metrics on our platform tend to be in the Midwest and Rust Belt. So kind of the reverse of what we typically think about as the hot markets. The kind of boring markets of the past are right now actually attracting a lot of demand from our buyers, at least.
I feel like this is a story that I saw when Mike Simonson does a weekly recap of the Altos data, and Midwest and New England seeing more demand. And then if you look at the NAR's recent story on the top 10 hottest markets, again, we see, Midwest and New England, in addition to some of the southern states. But, that surprised me because I was just like, really? Boston? Really? So not that it's not a great place. It's just, when you think about like the affordability and, their inventory and things like that. So I do think it's really interesting to see all of these indicators kind of pointing in the same direction.
Yeah, it is really interesting. And our buyers can get the thing about the Midwest and the Northeast too, that is an extra layer for our buyers, I think, is that there actually tends to be a little bit older inventory, which is good for our buyers because it gives them an opportunity to buy at a bigger discount a lot of times. With the older, more highly distressed inventory, that gives them a chance to add value through innovation more, but also buy at a lower price point. And so that's an extra layer for our buyers in those markets. And I think about places like Ohio, and where I just talked to one of our buyers the other day. They're doing some really creative things, which is cool. And he actually is not a real estate investor. He owns a small business, landscaping business, but he couldn't find housing for his employees, affordable housing for his employees. That was a struggle. So he actually said, he heard about buying at auction. So he's bought it like 3 properties at auction over the last 10 years, and he renovates them. But he's buying them for, the most recent one he bought off auction.com, I think, was around, hopefully I'm quoting this right, around $77,000 to buy it. It's hard to find that find a property that cheap. Now he put in $40,000 in renovations and then turned it around, and he rents it back at a reasonable low rent to his employees so they have somewhere to stay. So I thought, stuff like that is what we hear about. And it's kind of this slow boil of helping with the affordable housing crisis. It's not going to solve the crisis, but those kind of stories encourage me that there are people out there actually taking some of this distressed inventory and turning it around.
That's a really creative thing to do. And it's funny because Brooklyn Hahn right now is writing a story about New Hampshire and the fact of, the lack of inventory, because it's a state where you have to sometimes have like 10 acres to build one house. You have to have 3 acres, it's just very difficult to build. And so she's tying that into the fact that like when you go to the ER, you're going to have to wait longer. Guess what? Because they don't have any place for staff outside of doctors to really be able to afford a home in New Hampshire. So
wow.
It's just like all the effects that you don't think about when you don't have affordable housing or housing affordable to different layers of society. So I think that is very interesting.
Yeah. I mean, that, if we have time, that sparks another story. I just was in Montgomery, Alabama. I don't know why I got those two confused, but and talking, we're actually filming one of our buyers who has an interesting story. And he's one of these local community developers who has been buying for a long time, since 2004. He's been doing this, weathered all the different storms. And I think he owns about 300 units now total.
Wow.
But one of the things he was telling me is one of his biggest, there's a segment of those, not all of those have been purchased at auction necessarily, but there's a segment of those that are Airbnbs. And I'm like, it's interesting that you would have Airbnbs in Montgomery, Alabama. And he said, there's a huge demand. First of all, there's a large military population there. But there's also, he said, one of his biggest clients are traveling nurses who are coming around, and coming in to help with the healthcare situation there in Montgomery.
That is really fascinating. I just think there's so many layers, right? Like housing has so many layers. I love that you pointed out that these are the community developers. We know from all the stats that the people who are, the investors who are buying all the homes, there are investors buying homes. They are not typically Wall Street. So it's interesting that you said that at the top. Has that been the case since when in auction.com's history?
Well, since I've been here 5 years ago, and we didn't really have great data on this back in 2012, but I do hear anecdotally that you would have some of the big hedge funds coming to the auctions when there was a lot of volume. And back then, the thing about that crisis was there was a lot of newer properties going into foreclosure. And so these hedge funds could come in and buy a property that had just been built a few years ago and had gone into foreclosure at a discounted price. And so that I don't have a lot of good data on it, but actually I have looked at public record data, and it does support that maybe back in 2009 was the peak of those institutional investors buying at auctions specifically, and they were buying other places as well. But there's just part of it is there's just not enough volume for it to make sense for them at auction anymore. And then the other thing is we'd like to think we're a small part of that story. We've brought actual more transparency and competition to the auction. If you went to the auction 10 years ago, you probably wouldn't even know it was happening sometimes. There's just like a group of people standing around at the courthouse steps. And you still see that today for properties that aren't auctioned through auction.com, but we've brought this level, and sorry if I'm overselling us, but we brought this level of transparency that then brings competition. And so there's actually bidding wars for these properties that bring them up to the true value that they should sell for, given their condition. The market clearing price of those properties. And so that's chased away the institutional investors as well. They can't get that quick and dirty deal.
Well, and to your point, buying something that, maybe there's just some cosmetic things they have to do is totally different than buying really distressed property where you better know all your subcontractors, contractors, you better have deep roots in that community, or that stuff's never getting done or getting done in a way that you can make any money.
That's absolutely right. Yeah. I mean, these are properties that need work and need value added. And so this gentleman I talked to in Montgomery, he actually has a small warehouse of where he buys supplies in bulk so he can get them less expensive and put those into all the houses he's renovating. And so he has these efficiencies built into his system that help him, save costs when he's renovating.
That's so smart. That's so smart, especially, when we're talking about supply chains and tariffs and interruptions of, supply, what might happen. That's crazy. Well, Daren, you also had you wrote an article for HousingWire where you outlined some of these signals that you were seeing. And in addition to, what you're seeing with distressed property sales, there were some other pressure points that you talked about. Maybe we could go over those.
Yes, absolutely. I think, we're seeing this happening in our data, but also the other signals I'd point to is, number one, we've talked about it a little bit, but the inventory, rising inventory. And, a lot of people would argue that we're not anywhere near inventory levels that we were seeing even 5 to 10 years ago. Although we are, I would say, if you look at different data points, we're close to basically a 5-year high in inventory nationwide, and in some markets it's more than that. And so a lot of I see that inventory is the first domino to fall in slowing home price appreciation. We already have seen slowing home price appreciation this year, but I think that is a signal that it will continue. The more inventory you see, more supply. And we can talk about the more structural supply issue in a second, but the inventory is one. Second would be mortgage rates staying stubbornly high. And there was maybe a belief earlier this year that mortgage rates were going to be coming down more quickly. We haven't seen that happen. And there's more signals from the Fed that they're not going to be as aggressive as some might have once thought in lowering their interest rate. And you look at some of the forecasts coming out, and folks are forecasting mortgage rates staying above 6% for most of 2025. So that's going to put pressure on pricing as well. And then also a little bit more long term, if you look at price to income ratios over the long term, just we're about 26%. The median home prices that we have nationwide are about 26% above what they would be if we had so-called normal price to income ratios. And so that's a concern. Now, it doesn't mean, so I would say that indicates we have inflated home prices, or, some might use the term bubble. What that doesn't mean is that we're going to immediately see that bubble pop. It just means that we're in this situation, and it's caused because of this more long-term structural supply issue. That's probably the main driver of it. You don't have enough housing units built over the last 10 years to keep up with the number of households formed. And so that's allowing this inflated home price situation to happen. But you would expect to see that somehow revert to the mean and get back to more long-term average price to income ratios. And so that could happen either through prices coming down, wages rising, or some combination of those two happening. And I think I think my belief, it'll probably be more of a slow burn back to that long-term average price to income ratio as opposed to a crash. But that's the third thing that I would say is pointing to downward pressure on home prices in 2025.
And to me, this is good news, right? Because, at least home prices coming down, maybe not like falling, but also no crash, no instability. I mean, just feels like a more normal housing market, hopefully.
Yeah, I think so. I think one of the healthiest things for the housing market could be that reversion to the mean and price to income ratios. And hopefully it could happen in a way that's a little bit more measured and less of a crash. And I think that is pretty likely, just because given that there's not going to be all of a sudden magically 4 million units of supply that appear on the market that catch us up with the deficit that we've built over the last 10 years in terms of supply. But as that supply, you do see over the last few years, the supply in several of those years outpacing household formation. And so I think that's a good sign that we're slowly but surely catching up with that supply-demand imbalance.
Maybe to close out, give us some context of like what distressed sales, what part of the market they are today versus even, like 5 years ago when you joined.
Yeah, I mean, I can just give you numbers, and this is not just auction.com, but nationwide, there were about 200,000, a little over 200,000 completed foreclosure auctions in 2019. That was a low water mark at that point. Back in around 2009, 2010, there were over 1 million of those. So we're down to 200,000. Now we're down to about, we're on pace in 2024 for about 75,000 of those foreclosure auction sales. And so it's a very small sliver of the market. That's foreclosure auction sales specifically. You do have REO sales on top of that, which is another probably similar number. But it's still, a very small sliver of the 5 million retail market sales that you see kind of on average each year. So yeah, it's not. And I would mention, one of the other things that I think may put some downward pressure on home prices is we are seeing delinquencies, mortgage delinquencies, some early signs that those are turning a corner. Specifically, seriously delinquent mortgage rates increased in the third quarter, according to the MBA, after 13 consecutive quarters of decreases. And other Black Knight or ICE, I should say, and others have similar numbers. So there's some signs that that's turning a corner, but we don't see any signs that all of a sudden that 75,000 is going to balloon back to 200,000 in 2025 by any means. In fact, we actually are calling for that number to be flat or slightly down in 2025, that 75,000. But those rising delinquencies probably by the end of 2025 into 2026 could result in marginally higher foreclosure numbers as well.
So interesting. And when you hear the actual numbers, it really puts it into context, I think. So It feels like a healthier housing market in 2025 is likely. So that's what we're hoping for, right?
Yeah, I think so. I mean, I think getting back to, I guess, normal, it's hard to know what normal means in different minds, but it may, there could be, for sellers, homeowners have been in the driver's seat over the last few years. You may have to adjust expectations a little bit there in terms of what my house is actually worth is maybe not as much. And we've seen that on the part of our sellers who are the institutional, the banks, the non-banks. They're typically not emotionally tied to their property, so they're willing to lower prices. But we have seen that happen over the last 6 months as well, is that gradually lowering prices. And I think that maybe that's the bad news for 2025 is kind of this adjustment in expectations for price.
I think that's true. Daren, thank you so much. I can't believe we're already out of time. I really appreciate you coming on. Would encourage our listeners to go and read the story he did for us, which is super interesting, has really great charts and stats. And I just appreciate you coming on and talking to us.
Glad to be here. Thanks for having me.